What a week, my fellow real estate investment trust investors. We're in the fifth week of strong rebound. So essentially, at this time of the rally, you'll be questioning a few things. What? Which are the kind of REITs that continue to power this particular rally? Two, which are the kind of toxic REITs, even though they present a technical bounce, an opportunity for short-term profit to avoid for long-term problems. And three, how does one read this rebound? Meaning, how strong and to what extent should you be taking a positioning to take profits in this particular rebound? So essentially, these are the three things we'll delve into in this week's video as well as next week's video. So once again, subscribe and enjoy our channel. So once again, let's go on to the first one, ladies and gentlemen. So far, lesson number one that we've learned so far in this 5 weeks rebounds, this as this chart shows, strong REITs will stage the strongest rebound. And they have, ladies and gentlemen. Look at some of those that have posted double-digit growth in terms of the lows that were reached on the price on Thursday, 26th of October, and to compare to the prices that were reached on Friday last week. Capital Mall Trust up 11%, Ascendus REIT up 14%, Maple 3 Logistics up 10.9%, Capital DC REIT up 16.6%, Ascendus India REIT up 11.5%, CDL Hotel Trust up 11.2%, United Hampshire. What? United Hampshire, that's right, ladies and gentlemen. One of the rare REITs that many people actually follow, but at GCP Global, we follow them closely. And guess what? They are up 20%. Oh my goodness, ladies and gentlemen. Now, what are some of the key characteristics that these strong REITs actually exhibit? Well, let's take the first one. Let's profile United Hampshire because at GCP Global, for our investors, we actually had a dinner with the senior management, the CEO, Mr. Gerard Green, and Ms. Lu Wong Siu Lu, the head of IR of United Hampshire. And that's how we positioned our GCP Global Investor students to pick on this good stock when they actually had it sold down to 34 and a half cents in October. In our dinner, we actually established a few things. Now, if you look at the chart, ladies and gentlemen, now United Hampshire, in our classes all along, we have been positioning this REIT as a REIT that is ill-read by many investors. For example, many of them associate with United Hampshire being one of the US REITs. That means they are the likes of Life, the likes of Primary or Capital. But no, 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 they are not. They are actually into what we call strip malls operator, which is enjoy a very strong uh, revival in demand, especially after COVID. Now, essentially, so the lesson number one essentially is the fact that the misconception pricing REITs at a sharp discount during the sale. And United Hampshire fits into this categorically. Now, secondly, you may ask, ladies and gentlemen, what are strip malls? Mind you, ladies and gentlemen, it is actually malls that are actually not so relevant in this part of the world because of the cities and the metropolis that we live in. But United States, America, as well as in Australia, New Zealand, this is fairly normal because strip malls are essentially malls that are normally suburban or even semi-rural out of town. Okay, you could actually have a mall that's servicing like nearby three or four towns. Okay, and in this case, you can see that these are places that people go for their groceries, do their utilities, wash their laundry. So it is not as what many people would have thought that hey, strip malls are where strip centers are actually located. No, 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 nothing fuzzy about that whatsoever, ladies and gentlemen. The strip malls, according to Green Street Commercial Property, in the latest set of valuation. That means from June 2020 after COVID right up to September of 2023, meaning the last 4 years of performance, they turn out to be the fourth best asset class. So you want to be positioned in strip centers because they're only behind self storage, industrial, and logic in terms of the strength. So you can see, ladies and gentlemen, the lights of offices under Manulife, the light of offices under Prime REIT are not in this category whatsoever. All right. So in this regard, ladies and gentlemen, United Hampshire also have two assets, that is actually in self storage. So once again, ladies and gentlemen, the great performance of United Hampshire could be due to the fact that, when it was sold out 34 and a half, and that's where GCP Global investors actually bought in a big way. The option was actually due to three things. The damage that was actually caused by the association, what we call collateral damage, with the office sectors, players like Manulife and Primary, which we told you, no, 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 they are not related whatsoever. And two, rather good core earnings coming from New Hampshire. That is actually the triumvirate of three things. One is strong earnings growth, or strong reversion growth. Two, strong occupancies. And three, the kind of good assets that they actually own. Now you notice, ladies and gentlemen, this triumvirate of three factors, that is core earnings coming from strong reversion rental, high occupancies, and three, a good ownership of good assets that deliver on this two front will be key in picking the REITs, because these are the REITs that will be strong, and these are the strong REITs that will deliver the strongest rebound in this current rally, as what we have shown. Now, moving on, ladies and gentlemen, this next table show you the next 10 REITs that also exhibit fairly good rebounds, and these are fairly strong REITs. And what are this? Those with double-digit return so far has been Capital REIT 11.3%, Lendlease Global REIT up 26.5%, Star Hill Global up 16.7%, Fraser Logistics and Commercial 11%, ESR Logos with 22%. And hey, hang on, ladies and gentlemen, just last week we covered for you ESR Logos REITs, and why we told you that they also exhibit three things. One is strong occupancies, two, they actually have the good assets, and three, they are practically enjoying good, strong reversion rentals for all the sub-segments of the industrial space that ESR Logos operate in. So what about Lendlease Global, ladies and gentlemen? Yes, ladies and gentlemen, we just had lunch with Lendlease Global REIT CEO, Mr. Kelvin Chow. Yes, it is actually the gentleman in white, at the far end on the left of the photo, and next to him is Ms. Lin P. Lin, the IR of Lendlease. Yes, ladies and gentlemen, we catch up with all the REITs that we owned on a very regular basis, as much as once a quarter, to actually safeguard our investments. Like many of the REITs, we meet them once every 6 months to actually keep us appraised of the situation and understanding of assets. So in our GCP Global classes, when we present, you will get the latest information on this REIT. Mind you, ladies and gentlemen, you don't need to know what's the next quarter DPU or the next half year DPU is going to be. You don't even need to know which assets basically are giving strong returns, but you generally, once you have compounding ideas and compounding knowledge of the REIT sector, and yes, ladies and gentlemen, at GCP Global, we have been teaching for the last 34 years. So the compounding of this knowledge, makes you in a viable position to ask in-depth questions. And from the in-depth questions, you can then actually have a very good concoction of the kind of answers that you're going to get in terms of strong performance of this three core activity. One is reversion rental, two is occupancy, and three, the kind of good assets that the REITs have, which may be underappreciated by investors. And therein, ladies and gentlemen, is the option for you to buy as a REIT investor. So back to land release, you know, what is actually happening. You can see that when the share price was smashed down, as the chart shows, you can see, it went all the way down to below 50 cents. Can you imagine that, ladies and gentlemen, from its height of 90 cents a year and a half ago? We told our GCP Global investors nothing wrong with me, right? So, but why the huge sell down? One is that they are actually caught in a rut of rising interest rates when their European loans are being refinanced at higher rates. Remember, they own Sky Tower, which actually is in Milan. And unfortunately, the euro cost of funds in terms of loans has gone up much faster than Singapore dollar. The Singapore dollar cost of funds also went up because they went in to buy in full, the shopping center in Jurong, as well as they took a 10% stake in another suburban mall, that's Parkway Parade. So since IPO, for Lendlease until now, they have changed the complexity of this REIT. From owning two assets at Sky Tower and 313 Orchard, now they own three assets in Singapore, three shopping centers in Singapore, possibly more to come if they actually take greater stake in Parkway and essentially Sky Tower in Italy. The key thing, ladies and gentlemen, is that how do they position their loan structure such that the higher cost of funds does not impinge them as they what was doing to the share price when it went below 50 cents. We told you nothing wrong with the REIT, especially after an update during our classes from our lunch with the CEO. And looking at this, ladies and gentlemen, you can see this was my Lianhe Zaobao interview on Lendlease as well as other REITs. You can see that some of the names that were mentioned, in the Zaobao interview, includes the likes of good REITs, that's K-REIT, that's Capital REIT, Asker REIT, ART, CDL Hotel Trust, Fraser Centre Trust, L-REIT, that's Lendlease REIT, Mint, that is Maple Tree Industrial Trust, FLT, and Sanders REIT. You look back at these two tables where so far the REITs have staged the strongest rebound. And all these names practically appear in this table one or table two, right? So, ladies and gentlemen, it's no coincidence, therefore, that the REITs that you pick that are the strongest REITs will give you the strongest rebound. And which is the core earning properties, the core strength that power these REITs to stage the strongest count? Three things. The assets are good. Two, the assets are able to deliver strong double-digit reversion accounts. Everyone, to build core strength in your REITs portfolio, three things as I've mentioned in my video. So this is an exercise that you can do every day. It's called the Archer push-up. Okay, why? Because the Archer push-up actually allows you to move from left to right. We always watch for your REITs how they perform on these three aspects. One is strong occupancies, one is actually strong reversion rental, and whether it's actually good asset. Let me just do and show you one time, okay? And try to do it every day because you have to watch your REITs on a daily basis. Let's do the Archer push-up. Spread your hand as much as you can, ladies and gentlemen. Okay? Move to the right. Move to the left. Move to the right. Move to the left. Move to the right. Watch carefully. Yes, enjoy it. Move to the right. Move to the left. Yes, move it up. Move your butt up. Move your butt up. Watch it. Strengthen your core strength. Once again. Yes. And do 10 sets every day. Because why? It strengthens your biceps, strengthens your triceps, it strengthens your anterior deltoids. Rentals. Three, these assets, because they are good, they continue to have strong occupancies despite enjoying high reversion account, meaning that tenants are more than happy to pay you, the REIT, for their asset, even though at higher rental, despite economic downturns. Okay, so the third REIT that we talked about was actually covered in detail last week in our detail video on ESR Logos because they were the best performing industrial REIT within the sector. And so far this week, they have continued to deliver. So essentially, do look back at our last week's video, but essentially, the key thing, as we pointed out in last week's video, is that ESR operates in four industrial sectors. That's high specs industrial, logistics, general industrial, and business park. And for the first time, as we have mentioned in last week's video, their latest set of business update shows that the market rentals for all these assets in this portfolio are showing and enjoying higher rentals than the passing rent. What does it mean? It means that when these assets come up for renewal, the probability of ESR enjoying a higher rentals from the same tenants and from the same assets are much going to be at least 10-20% higher. This means that the underlying DPU strength going into next year, 2024 and 2025 for ESR is going to be positive. And that's what you look for in strong REITs. So ladies and gentlemen, in this big video, we covered only just the first point, that is, strong REITs deliver or are able to deliver the strong performance. And we have seen so far that this rally, this has been the case, something that we have taught in our GCP Global investors classes. Now, the second thing to note, take note on this rally is that how to avoid those toxic REITs. Okay, now the temptation to buy this toxic REITs, for a bounce, is very high right now simply because they were toxic REITs and they were sold out very badly. Should you then take a trading opportunity? We'll cover this in next week's video. And third, we will also tell you next week, essentially in next week's video, the third thing about this rally is that you must be in and be prepared to be taking some profits, when the rebound reaches its mature stage. So to that, like us, subscribe to us, and enjoy this coming week rally as well.